And welcome to the Global View on this Monday. I'm Andrew Gagan. Great to have you with us here at ausbiz. Let's first take a look at what happened on Friday. Global stocks rising, with investors buoyed by stronger than expected US labour market data. US markets were also cheered by the end of the strike by US dock workers. So on Wall Street, the Dow closing at another record high, while the S&P 500 and Nasdaq also finished positively, with small caps and financials outperforming. Now, for the week, the major indices registered just slight gains following concerns about those increasing tensions in the Middle East. And that has affected energy, that sector doing very well. The energy index on the S&P having surged 7% for the week, in its biggest weekly percentage gain in 2 years, as oil prices jumped on concerns that the Middle East conflict could impact crude output. Stocks, specifically Spirit Airlines, plummeted, while other airlines jumped after a report showed Spirit was in talks with bondholders about a potential bankruptcy filing. United Airlines and Delta doing well. Rivian shares fell after the electric vehicle maker cut its full-year production forecast and delivered fewer vehicles than expected in the third quarter. And third quarter earnings for the S&P 500 companies will begin at the end of the week, with the major financial firms the highlight, with JP Morgan, Wells Fargo and BlackRock to report on Friday. Well, US job gains increased by the most in 6 months in September, and the unemployment rate fell to 4.1%. In addition to the bigger than expected increase in non-farm payroll, wages rose at a solid pace last month. Non-farm payrolls increasing by 254,000, the most since March. And on that news, Chicago Fed President Austin Goolsbee has called the latest US jobs data superb, boosting his confidence the economy is at full employment with low inflation, saying you really couldn't ask realistically for a better report for the economy, coupled with finding out that the port strike is not going to be an extended matter. Those are two pieces of very good news for the economy. Well, US 10-year Treasury yields, they climbed to the highest in nearly 2 months on Friday on that jobs data, up 14 basis points to 4.98%. The 2-year jumping more than 22 basis points to 3.92%. And financial markets are now pricing the odds of a 0.25 percentage point rate reduction in November to 95%. The US dollar rallied to a 7-week high against a basket of currencies, the Aussie falling back to 68 US cents. And taking a look at commodities, oil prices notched up their biggest weekly gain in more than a year on the mounting threat of a region-wide war in the Middle East, although those gains were limited as US President Joe Biden discouraged Israel from targeting Iranian oil facilities. Brent crude futures up more than 0.5% at $78 a barrel. Base metals were down across the board on Friday. The gold price also slipping down to $2,652 an ounce. And Bitcoin higher over the weekend to trade at around $62,500 US dollars. Well, let's get a sense of that investment picture, particularly what we're seeing in the States at the moment. Chad Padowitz joining us from Talaria Capital. Chad, very good to catch up with you again. Thanks for joining us on this Monday here. Now, of course, we just had that latest economic data out of the States, but interested that how you're viewing the overall investment picture in the US at the moment. And you're going to point to, I guess, the market cycle and how it operates.
Yeah, sure. Look, no doubt there was quite a strong employment number, but it comes on the back of some weaker numbers in the prior months and some negative revisions. So it is quite bumpy, and that's why I think it's quite important to take a slightly broader view of economic cycles and how they operate. And very briefly, if one thinks of it in 4 stages, one can say the first stage would be when earnings have troughed, but there's an expectation that the economy is going to improve. And in that environment, share prices actually go up on the expectation of things getting better. So PEs expand. The next stage is when that earnings actually ultimately do deliver and corporate profits do grow. Share prices go up alongside that. But you also get around that time interest rates start going up. And then the third stage is when those things tend to peak. So interest rates and the economy tend to, hit their peak. And the last stage, which is the fourth stage, which we think we've just entered, is when you now lower interest rates. And that tends to be where you have market leadership changes, because the weaker economic environment starts to impact the broader economy, starts to impact even growth companies. So those high valuations tend to get into trouble because growth traps start appearing. So it's a far more complicated environment when you're in that final stage where we are right now.
Are we though there, Chad? Because obviously those interest rates, the easing cycle has begun in the States. But to that point of the strength of the US economy underlined by that latest non-farm payrolls report, are we really seeing weakness in the US economy?
Yeah, well, there's a lot of signs of weakness. But what you've really got is a bifurcation. So even that strong jobs number, it was strong in the non-cyclical part. So the part that relies more on discretionary spending was actually not that strong. And that's been what's happening in the US economy for quite some time. The wealthy, the ones that own assets, the one that earn interest and dividends are actually doing very well. But the other part of the economy, people that are far more impacted by higher interest rates, lower income, are taking it a lot tougher. So there is that bifurcation, and there's been no evidence in the last several months or quarters that hasn't been increasing. So it's really a tug of war between some of those things going on. But broadly speaking, it isn't net. The US economy is a highly indebted one at both the corporate, at both the individual, and certainly at the federal level. So the period of higher interest rates up till now are having an effect. And even with lower interest rates, it tends to be quite a long lag time before that starts positively impacting. So we think, while we don't have a crystal ball, and as you said, there are different views and data that go each way, we think broadly speaking the valuation you're paying for things now is very high. So even if the delivery is quite good, you're not getting much compensation. So the skew is actually quite negative in the event things are not so good.
Given that then, Chad, how have you adjusted your portfolio?
Yeah, well, the factors that we think, one, from a bottom-up point of view, we're always looking for value-based, high-quality, strong free cash flow type businesses. We think that is actually the environment. This cycle tends to favor high free cash flow, high returns on capital, good balance sheet. So that's what we think investors should focus on. And certainly in our portfolio, we have companies like that. Pharmaceuticals are a very good example, consumer staples, to some extent utilities, and certainly where we're not, where we think some of the risks are the highly valued growth companies.
Chad, will the outcome of the US election alter your investment perspective at all?
No, very, very unlikely. It's a very large US economy. It doesn't move from policy that quickly. And we think, broadly speaking, for quite some time, the economic environment is already broadly baked into the cake. And what will be has been already to a fair extent, is more economics, interest rates, where we are in the economy. I don't think changing of the presidential, of presidents is going to have a material impact, certainly in the short to medium term.
All right. Well, beyond the States, so you've got a broader focus, of course. You're also looking at Europe, for instance, with one stock in particular that you're bringing to us today, Randstad. Tell us about this one.
So Randstad is quite a global talent company. They're effectively a form of an employment type agency type business, generally more on the temporary side. They do about 25 billion revenue, about 8 billion euro market cap. Now their shares have come down, quite significantly, or a fair amount in the last year or so. We see that as an opportunity because the shares have come down because the economic environment for them has gone tougher. So their earnings expectations have also come down. But now you've got a valuation and a sales number that we think is trough on trough. So we see this as a pretty good environment to buy a very high quality company at a very attractive valuation with now broadly depressed earnings. They have an excellent balance sheet, very low they're very highly flexible cost structure. So if revenue drops, they can drop their costs almost the same, so they can keep their margins broadly stable. So because of that, we see this is a pretty good opportunity. They pay out almost everything in a dividend, so the dividend yield is 5, 6, 7%, just depending where they will land. But it's a pretty high dividend, strong balance sheet, very good valuation, well-run company.
Overall, Chad, when you look at Europe, how do you look at the valuations there with equity markets?
Well, certainly the US is by far away the most expensive region. So the more you move away from the US, things do tend to look a lot more attractively valued. And that is across sectors. It's not just because of the sector mix there. We certainly see Europe as home to some very good companies. It's not really a view on the European economy. It's rather about those individual companies that happen to be listed there. So Randstad, as an example, Netherlands-based company, but operate in 39 countries. So, but we see, Europe hasn't had the money flow of the US, and it hasn't had the exuberance of expectations. So, we definitely see that as home to more attractively priced companies for us.
Chad, always great to get your investment outlook there at Talaria Capital. Thanks for joining us.
No, you're welcome. Thank you very much for having me. Bye-bye.
Let's have a look locally. We're expected to open on this Monday, bearing in mind too, volume's expected to be light because all but Victoria and WA do have a public holiday today. But SPI futures there, we are looking for a positive start. Stay with us because the open is just a couple of minutes away.